Welcome back to Talk Tickers, the essential earnings called digest for the busy professional. We cut through the noise, skip the safe harbor statements, and get straight to the alpha.
Absolutely.
Today, we are dissecting a company that has, arguably been the sleeping giant of the S&P 500. We're looking at Kinder Morgan, ticker KMI, and their Q4 2025 earnings. And frankly, the whole narrative on this stock is just completely flipped.
It really has. I mean, if you haven't looked at Kinder Morgan in a few years, you probably still have it filed away in your head as a boring, slow-growth pipeline utility.
Right, a yield play.
Exactly. You buy it for the yield, you ignore the chart, and you hope nothing breaks. But this quarter was a wake-up call that the business model is evolving, faster than the share price.
The market definitely smelled something cooking. We have to start with the vibe check. The stock finished up about 2.2% going into the close, and then bam, tacked on another 2.24% in the after hours.
A near 5% move for a midstream energy company is not normal behavior.
Not at all. That's usually a year's worth of movement in a single afternoon.
It's significant. We aren't talking about a volatile biotech stock here. This is a company that moves in inches, not yards. The sentiment right now is distinctly bullish to constructive.
So what's changed?
I think investors are realizing this isn't just a yield play anymore. The market's starting to reward what looks like a very disciplined cash return story set against a surprisingly strong macro backdrop.
And that is the hook for this whole deep dive. This isn't just a we move molecules from point A to point B story anymore.
Yeah.
This is becoming a gas demand enabler story. We're talking about the physical infrastructure required to power the AI revolution.
It's a pivot to power.
Yeah.
And that's what we're going to unpack. I mean, they delivered a boring, steady beat on the numbers, sure. But the commentary is all about the future of electricity and the grid.
Okay, before we get into the sci-fi future of AI power grids, let's eat our vegetables. We got to hit the results snapshot. Is the core business actually performing?
It is. The headline numbers were a clean beat. GAAP earnings per share came in at $0.39.
And consensus was?
Consensus was $0.37. So a solid 2-cent beat on the bottom line. But I think the revenue number is actually more telling here.
What did we see on the top line?
They posted $4.508 billion in revenue against a consensus of $4.328 billion.
That's a big beat.
It's a significant $180 million beat, and importantly, it's up over 13% year over year. When a company this mature grows revenue by double digits, it implies real volume demand, not just, accounting tricks.
And the cash flow.
Yeah.
Because for midstream, EBITDA is usually the metric that matters most.
It was strong. Adjusted EBITDA for the quarter was $2.248 billion. And for the full year of 2025, they hit a record $8.255 billion. So the cash engine is humming. They're just generating massive amounts of liquidity.
Which brings us to the guidance. The market is a forward-looking machine. What are they telling us about 2026?
The outlook is healthy. They're forecasting 2026 adjusted EPS at 1.36 cents. And EBITDA at $8.3 billion. But here's the nuanced nugget that I think some algorithms might have initially flagged as negative.
Go on.
But humans realized was positive. Net growth CapEx is rising.
Right. Capital expenditure. Usually investors hate hearing that spending is going up. They want companies to tighten their belts.
Exactly. But they announced growth CapEx is rising to roughly $3 billion, up from the previous guidance of $2.5 billion.
So an extra $500 million.
And in this specific context, that extra $500 million isn't bloat, it's growth. They aren't burning cash, they're investing in high-return infrastructure because the demand signals are just flashing bright green.
And they're still balancing that spending with returns to shareholders.
Yes. The board approved a 2% dividend increase for 2026, bringing it to $1.17 annualized.
Okay.
So you get the dividend growth, you get the steady cash flow, but now you're getting this embedded capital appreciation story right on top of it.
Okay, so the foundation is solid. But let's get to the meat of this. Why did the stock pop? Why is everyone talking about pipelines again? It comes down to theme number one. The gas supercycle.
Rich Kinder, the executive chairman, he opened the call with some incredibly bullish language. He used the word astounding.
Astounding.
He's looking at natural gas demand growth and calling it astounding. And he pointed to two main drivers, LNG exports and electric power generation.
Let's break those down, starting with LNG, liquefied natural gas. We know the world wants U.S. gas. What do the numbers actually look like?
They're staggering. Rich noted that feed gas demand, that's the gas flowing specifically into export terminals, is estimated to average 19.8 billion cubic feet per day in 2026.
Nearly 20 BCF a day. That's just...
It's an all-time record, up 19% just from 2025. And they project that number hitting 34 DCF per day by 2030.
Wow.
I mean, think about that ramp. That's a massive volume growth. And remember, Kinder Morgan sits on the pipeline networks in Texas and Louisiana that act as the toll road for these terminals.
You can't get it out of the country without them.
You cannot export American energy without using their infrastructure.
But the LNG story, while huge, is something the market has arguably known about for a while. The real surprise, the aha moment of this call, was the pivot to power and data centers.
Absolutely. This was the shift. CEO Kim Dang highlighted that it's not just about sending gas overseas anymore. It's about keeping the lights on at home. And she cited a specific example from Georgia Power that really contextualizes the scale of this.
Walk us through that.
So in a recent filing, Georgia Power projected 53 gigawatts of power demand growth through the early 2030s.
53 gigawatts. I mean, for the non-engineers listening, that is an enormous amount of power.
It's colossal.
Right.
And Kim Dang did the back-of-the-napkin math for us. If that demand were met 100% by natural gas generation, it would require about 10 billion cubic feet per day of gas.
Just for one utility in one state.
Just for one. That is insane leverage to the data center build-out.
And she said this isn't just a Georgia problem, right?
Correct. She mentioned they're seeing similar stories across Arkansas, Louisiana, and Texas. The driver here is clear. AI chips run hot.
Very hot.
They need massive power, and the data centers housing them need constant cooling. Renewables like wind and solar are fantastic, but they're intermittent. The sun doesn't always shine, the wind doesn't always blow.
And data centers need baseload power. They need 99.999% uptime.
Exactly. You can't have ChatGPT go offline because it's a cloudy day in Atlanta. Natural gas is the bridge that provides that reliability. Kinder Morgan is, effectively positioning itself as the battery for the AI grid.
So if demand is skyrocketing, that must mean they have a lot of work to do. Let's talk about the backlog. This is theme number 2.
The backlog is the crystal ball. It tells you what revenue is locked in for the future. Their project backlog jumped from $8.1 billion to $10 billion.
That's a huge step change.
It's a massive step change in secured future work.
And what's inside that $10 billion? Is it all just replacing old rusty pipes?
Not at all. And this is what concerns the pivot we were talking about. 60% of that backlog is associated with power projects, including data centers.
So the utility sector has overtaken exports.
As the primary driver of their construction business, yes.
But there was something even juicier in the Q&A session, a concept that sounds a bit clandestine, the shadow backlog.
It does sound mysterious, doesn't it? But it's a very real thing. In this industry, the backlog only counts projects that have reached a final investment decision, or FID.
So the contracts are signed, money's allocated, it's a done deal.
Right. The shadow backlog refers to all the projects they are actively working on, designing, negotiating, but that haven't reached that final signature yet.
Okay.
Management revealed they're working on over $10 billion in opportunities beyond the official backlog.
Wait, so the visible backlog is $10 million, but there's another $10 billion iceberg floating underneath it.
Exactly. And here's the kicker. Only about 12% of that shadow backlog is LNG.
Which means the rest.
The vast majority is power and data center demand. That's the hidden value right there.
The market is pricing them on the $10 billion they have signed. But there's another 10 waiting in the wings.
And you have to consider the speed. LNG projects take years, sometimes decades, connecting a pipeline to a new power plant. That can happen much, much faster.
So the revenue could come online sooner than people think.
It suggests a runway of growth that stretches well into the 2030s.
Speaking of getting things done, let's move to theme number 3, major projects update. They gave us some specifics on the hardware they're putting in the ground.
Yes, 3 big ones to watch. First, the Trident pipeline. Construction has officially started. This is targeted to monetize intrastate demand in Texas.
Why does intrastate matter? Why is that distinction important?
Because Texas is unique. It has its own grid, UCAR, and its own regulatory environment. If a pipeline starts and ends within Texas borders, it avoids a lot of federal red tape.
It's faster.
It allows them to move faster to meet that booming demand.
Got it. Then there's MSX and South System 4. I heard some surprisingly good news on the timeline there.
You did. These could be online early. We're talking potentially Q2 of 2028 instead of Q4 2028.
In the world of major infrastructure, finishing early is almost unheard of. How are they pulling that off?
Regulatory wins. They highlighted the removal of the 871 rule, which was a hurdle for cross-border projects. With that gone, and with SERC, the Federal Energy Regulatory Commission processing applications faster.
How much faster?
Down to about 12 months. Things are just speeding up. It feels like the reality of our energy needs is finally setting in.
It seems so. And finally, the Western Gateway.
Right, a partnership with Phillips 66. This is about connecting Midwest refiners to markets in Arizona and California.
Okay.
And the smart financial detail here is that Kinder Morgan isn't just writing a check. They're contributing existing assets, their SFPP lines, so their cash contribution is less than 50%.
Smart. Using existing steel to buy into new growth, that preserves the balance sheet.
Exactly.
Which brings us to the investor context. We have to talk risks. Analysts did dig in on some concerns.
Yeah, the main worry came from a question about the Bakken Shale region. An analyst noted that Continental Resources has stopped drilling there.
And if the drilling stops, the pipes run empty. That sounds scary.
It does, but management's rebuttal was swift. They clarified that the Bakken region only accounts for about 3% of Kinder Morgan's EBITDA.
So a drop in the bucket.
They called the impact very manageable. It just highlights the benefit of having such a massive, diversified network.
And they're actively managing that portfolio too. They mentioned the Eaglehawk sale. Why sell assets if you're in growth mode?
It's about capital discipline. Yeah. They sold that asset at an 8.5x multiple.
Good multiple.
Very good. They looked at the math and realized they could get better returns reinvesting that cash into these high-growth power projects. It's classic asset rotation, sell low growth, buy high growth.
And the balance sheet supports that strategy.
It's fortress-like. Leverage is down to 3.8x, which is comfortably within their target range.
Yeah.
And S&P recently upgraded them to BBB+ stack. That lower cost of capital is a massive competitive advantage.
Okay, before we get to our favorite segment, we have to touch on the macro environment. The weather. It's been a weird winter.
It has. Management noted that the Q4 beat was partly driven by tight gas transportation markets and volatility.
Right. In the gas world, volatility is profit.
It is. When it gets cold or when weather gets wild, prices dislocates. This is the basis spread, right? The price difference between two hubs.
Exactly. If gas is cheap in Texas but expensive in Chicago, and you own the pipe connecting them, you capture that spread.
But they made a specific comparison to Winter Storm Uri. Right.
They did. They explicitly stated this current winter storm is not a Uri event, it's shorter. But, and this is key, even without a catastrophic event, just having those basis dislocations provides upside for their storage portfolio.
They're the shock absorber for the grid, and shock absorbers get paid when the road is bumpy.
So let's recap. We have a beat, a pivot to power, a massive shadow backlog, and solid financials. Now, it is time for the segment where we take off the analyst hat and put on the what-if hat. It is time for our not financial advice segment. Please remember, this is for entertainment purposes only. Do not trade on this. We're just two voices in your headphones.
A very important disclaimer.
Well, if I were pitching a wild trade idea right now based on this call, here's what I'd say. I call this the shadow spread arbitrage.
The shadow spread. I'm listening.
The market is currently pricing Kinder Morgan like a utility. Low beta, steady yield, boring growth. But if you actually listen to Kim Dang, KMI is a hidden AI and data center play.
Because of the 60% power backlog.
Exactly. So here's the trade. You go long KMI calls, targeting the backlog expansion updates.
So you're betting on the news flow.
I'm betting that the shadow backlog converts to FID faster than the market expects.
Yeah.
Utilities like Georgia Power are desperate. They need power now.
They can't wait 5 years.
No. And when those shadow projects get announced, the market is going to have to re-rate KMI from a yield play to a growth play.
That's the arbitrage. You're buying the optionality on 53 gigawatts of power demand, but you're paying a midstream multiple for it.
Yes. It's a pick and shovel play for the AI compute build out, but it's trading like a bond proxy. If that multiple expands even a little bit because the narrative shifts to AI infrastructure, those calls go.
They go nuclear.
Purely nuclear.
It is a compelling thesis. You're effectively betting that the shadow backlog is real and, more importantly, urgent.
And that is the shadow spread arbitrage. Again, not financial advice, just something to chew on.
It definitely highlights the asymmetry in the story right now.
So let's wrap this up. What's the main takeaway for the listener today?
Kinder Morgan delivered a beat and raise quarter. They hit a record year in 2025. But the real story is the fundamental shift in their identity.
Right.
The story has shifted from how much oil can you move to how much electricity can you generate with this gas.
That's the pivot. The molecules are the same, but the end user has changed from a combustion engine to a graphics processing unit. And that changes the valuation dynamics completely.
It does. It makes natural gas a technology enabler. And for a company with the largest network of pipes in the country, that is an enviable position to be in.
Well, there you have it. The boring pipeline company might just be the most exciting AI trade nobody is talking about yet. Check your own models, do your own diligence, and standard disclaimers apply.
Always.
We'll catch you on the next print. Thanks for listening to Talk Tickers.
Bye, everyone.
See ya!